Anthony Grasso here, bringing you financial news that you can use. In this particular video, I'm going to do a stock analysis on Tesla. Now, is this company worth investing in right now before and after the stock splits tomorrow morning? Well, let's find out together. I'm going to go over a summary of the company, its product offering, recent headline news, financials, analyst predictions. I'm going to give it my buy, hold, or sell recommendation for both the short-term and long-term growth investors out there. And I'll go over what's going to be happening with that stock split and what it means for you. All right, and as always, folks, don't forget to smash that like button down below and consider subscribing. Hit that notification bell to like your daily stock reviews and recommendations from an unbiased source. So let's get right into it. As always, folks, this video is brought to you by Webull, which is an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. If you sign up today and deposit any amount, you can get up to 12 free stocks by using my referral link in the description down below. All right, so everybody should know what Tesla is. I mean, you see them all over the road. So I'm just going to briefly go over this. So the Tesla designs, develops, manufactures, leases, and sells electric vehicles and energy generation and storage systems in the United States, China, and internationally. Now, the company operates in two segments, the automotive and the energy generation and storage. Now, I'm not going to go over both of those segments, but just know that that they're doing great. All right, so let's look at some of the news of the company right now. All right, so this is the biggest news to hit the wire, and it's been known for a few weeks now, or a few months, that they were going to do this. Now, the company will enact a 3-to-1 stock split. Now, this means shareholders will get what amounts to a dividend of two additional shares for each share they own, with the share price divided by 3. So whatever it's currently trading at, just divide by 3. That's what the stock is going to be tomorrow. Now, Tesla does cite that they want to make the shares more accessible to investors. Now, before I get into what all this means for us, let me go over some fundamentals of the company right now. All right, so the stock is currently trading at $892 a share with a market capitalization of roughly $937 billion. Now, the company is projected to have $84.86 billion of revenue for 2022, with positive earnings of around $12.5 billion. Now, the revenues are projected to significantly increase over the next few years to roughly $144.46 billion by the end of 2024, and they should have revenues of or earnings of around $23 billion by the end of 2024. So that's really great. Now let's look at some key measures of this company right now to look at the valuation analysis. Okay, because Tesla is in the automobiles industry and has positive earnings, the price to earnings growth ratio and the PE ratio, price to earnings, and the price to book ratios are the most appropriate valuation measures. The price to sales ratio is less instructive because of the PE and the PEG ratio, since the company has positive earnings. Therefore, Tesla seems extremely highly valued, with the highest PEG value in the automobiles industry of 2.11 times, which is supported by a price to earnings ratio of 97 times right now. That is the highest in the industry. The industry average is only 8.3 times. Now, if you look at the price to earnings versus the fair ratio, which takes into account the company's forecasted earnings growth profits, and other risk factors, Tesla also seems expensive based on its price to earnings ratio of that 97 times compared to the estimated fair price to earnings ratio of 26 times. So about 4 times overvaluation with that. And then if we look at the share price versus the fair value, and when you're looking at the future cash flows, for this estimate, we're going to use the discounted cash flow model. It's below value. The Tesla's trading at above the estimate of the fair value, which is only $556. Now, we all know that Tesla is trading way above valuations, but it always has. And I believe Tesla will always sell way above the current valuation numbers as long as their stellar growth is projected to increase year over year. And everybody loves Tesla. It's all about the EV craze right now. Now, if we look at the profitability of this company, now based on its gross margins, operating margins, and net margin, Tesla converts a larger percentage of its revenues to profits than most of the other companies in the automobiles industry. Furthermore, the company is profitable with an operating margin of roughly 15.9%. Now, the current net profit margins are higher than last year's. They were only 5.1% last year. So they definitely have a growing profit margin. And like the rest of its peers, they don't pay any dividends. And if you look at the growth rates analysis, Tesla outpaced the revenue growth over the past trailing 12 months. Now, this is a trend that is not sustainable if profits are continue to grow at this rate. However, this result was better than that of the average company in the automobile industry. And the earnings trend has been, they have been profitable, became profitable over the past 5 years, and they've grown their earnings 80.7% per year. They do have high growth earnings. The earnings are expected to grow significantly over the next 3 years. And the earnings growth over the past year was 342%. That exceeds its 5-year average of 80.7%. And it's growing the earnings. If you compare the earnings versus the industry, the automobile industry only increased their earnings by 46%, while Tesla 342%. And now finally, let's quickly go over the financial strength analysis. Now, the debt to total capital ratio is approximately 10.5%. That's in line with automobiles industry's norm. The company's balance sheet shows the liquid assets are plentiful enough to service current liabilities in the event that operating earnings are unable to. They have more cash. They're hoarding cash basically than its debt. The debt to equity ratio has reduced from 122% all the way down to 8.4% over the past 5 years. And it's well covered by operating cash flow of 446%. And the interest coverage, the interest payments that are well covered by EBIT, 53.9 times. And the short-term assets of $31 billion exceeded short-term liabilities of $21 billion and its long-term liabilities of $9.0 billion. But it is important to note that insiders have only sold shares over the past 3 months. So what exactly have the analysts say regarding this company? Well, the current consensus right now is a buy and strong buy, with 31% of analysts saying buy and 27% saying strong buy. Now, the average price target of Tesla by these analysts over the next 12 months put it at around $886 a share, with a high estimate of $1,300 and a low estimate of $73. I mean, seriously, $73. I don't know what analysts were smoking that day, but I guarantee you, it's not even going to come anywhere close to that low number. All right. Well, let's go over to a few of the analyst reports that I found. So the Street Quant Ratings report, they have a buy recommendation. It's driven by some of the important positives, which they believe should have a greater impact than any of the weaknesses, and should give investors a better performance opportunity than most of the stocks that they cover. Now, the company's strengths can be seen in multiple areas, they say, such as its robust revenue growth, impressive record of earnings per share growth, compelling growth in net income, notable return on equity, and good cash flow from operations. They feel the strengths outweigh the fact that the company shows low profit margins, but their profit margins are definitely increasing right now. I've shown you that. Now, the Ford Equity Research Report, they have a hold recommendation, and they project Tesla will perform in line with the market over the next 6 to 12 months. And the projection is based on the analysis of the 3 basic characteristics that influence common stock performance. They say the earnings strength, the relative valuation, and recent stock price movements. And finally, the last report we're just going to briefly go over is the CFRA report. Now, they have a strong buy recommendation on Tesla, and that reflects their view that the completion of the new factories in Texas and Germany sets the stage for further growth into 2022 and beyond. And I've told you the projected earnings and revenues for Tesla are going to be skyrocketing into 2023 and 2024. Now, they also believe that the first deliveries of the Semi could come sooner than most expect, followed by the Cybertruck, the Roadster, and the Optimus robot. That's crazy. So the Cybertruck is believed to have reservations of more than 1.3 million. And by the way, I'm one of those 1.3 million people. I have a Cybertruck reservation. My brother has a Cybertruck reservation. I want the quad motor one. I know it's going to be expensive, but I really want it. All right, so the CFRA pegs the Tesla at the biggest winner from the Inflation Reduction Act. Now, I don't think so, and I'll get into the reason why I don't agree that they're a winner of that act. That was signed in August 2022. As most versions in the industry's 2 best-selling EVs, the Tesla Model Y and the Model 3 are eligible for that $7,500 federal EV tax credit, and it's effective January 1st, 2023. All right, but I'll get in my thoughts regarding if they're a winner on that. All right, so let me bring it back over here. But based on all that, what is my recommendation on Tesla? You know, here are my thoughts regarding if you should buy or sell or hold Tesla. Now, the true question that investors are expecting Tesla's stock to do after the split tomorrow, that's the real question everybody's wondering. Is like, what's going to happen? Is this stock split good news or bad news? Now, it's going to be trading at 1/3 the value on Wednesday. So when you log in your trading accounts, don't freak out if your trading platform hasn't updated everything yet. It might just say, oh, it's down 70%. Just, you know, it's going to be 1/3 of what it closes at the end of bell today. Now, Tesla's enacting that stock split by paying that stock dividend of, you know, what I said, 2 shares for each share held. So it's 1 for 3. Typically, investors love stock splits. Now, for one, it's a positive signal about the future of the company. A company doesn't split a stock they expect it will drop. You know, for me, it's great because it also makes shares less expensive. There's so many retail investors out there that says, I would love to get into Tesla, but at $900 a share, it's a little more difficult for them to even buy one share alone. I mean, it would be nice for them just to buy one share at $300 a pop, then $900 a pop. It also makes trading options in a stock less expensive as well. Now, Tesla has done a stock split before, which was back in August of 2020. Now, after the stock split of 2020, shares gained an incredible 81% between the stock split announcement and the day the stock split. Now, as of right now, the stock is up about 5% since they announced the 2022 split. Now, over the time, the S&P 500 is down about 2.2% over the same time frame. So basically, Tesla is outperforming the market, but nowhere near the 2020 split. Now, I see that the reason for not that big of a hype this time is because Tesla has been discussing the split since March, and it's official now in August. So it's not a surprise announcement relative to the first one. So relatively speaking, comparing this stock split versus the first one, shares back in 2020, it declined the next day after the split in 2020 and moved lower by 14% over the next months. However, when you fast forward 6 months, bam, the stock is up 36%. So in the long run, Tesla has outperformed and performed very well after the stock split. Now, no one has a crystal ball. Just because there might be correlation, it doesn't always equal causation. So now I think it's great news regarding this, but I always feel that the overall direction that the company is going, as well as the health of the overall economy, should have more weight than just the news of the stock splitting. Now, of course, Tesla shares will be affected by the health of the overall economy, along with its own electric vehicle deliveries and profits. Now, Tesla is trading slightly above valuation right now, or significantly if you look at certain things. Now, in light of the U.S. Senate passing that Inflation Reduction Act, the bill, which is likely to become law, would offer $7,500 tax credit for EVs if those vehicles and the consumer purchasing meet certain conditions. Now, however, I think that most Tesla vehicles most likely will not qualify for the tax credit. First, the credit does not apply to sedans over $55,000 or SUVs priced below $80,000. So half of their vehicles aren't going to apply. Now, based on the company's current published prices on its website, all Model S's and Model X vehicles would be excluded, as well as the performance Model 3s. Now, I wonder why the government capped it at that. I mean, maybe they looked at Tesla's website before making that decision on where they're going to cap that number. Hey, I'm not speculating here. I'm just saying the government shouldn't be hating on Tesla. You know, we all love Tesla. So in addition, second, the bill has a provision that requires a growing percentage of critical materials be sourced, extracted, or processed from either the United States or countries where the U.S. has a free trade agreement. Now, that threshold starts at 40% and grows to about 80% by 2027. Now, if we examine Tesla's 2021 impact report, the company's lithium hydroxide is either extracted in Argentina or processed in China. In addition, The company's cobalt either comes from China or the Democratic Republic of Congo. In my opinion, majority of longer range vehicles, which typically use batteries with lithium hydroxide and cobalt, would likely be excluded based on the current sourcing. Now, what Tesla could do is work with suppliers to incentivize the build out of processing plants in the United States, but this would likely take years before the company could secure enough battery materials for the majority of the vehicles to even qualify for that tax credit. So I don't think the bill will have any significant impact on Tesla's bottom line in the near term, just slightly with the lower end vehicles, but it won't be a significant bump. Now, I love Tesla's business strategy as well to date. You know, they are the largest battery electric vehicle automaker in the world right now. And Tesla's strategy is to maintain its market leader status as EVs grow from a niche auto market to reaching mass consumer adoption. To do this, the company is undergoing a massive capacity expansion to increase the number of vehicles it can produce. Tesla also invests around 5% of its sales in research and development, focusing on improving its market-leading technology and reducing its manufacturing cost. You know, for electric vehicles to see mass adoption, they need to reach cost and function parity with internal combustion engines. You know, to reduce costs, Tesla focused on automation and efficiency in its manufacturing process, such as reducing the total number of parts that need to be assembled in a vehicle. Now, the company will also move upstream into battery production with a goal to reduce cost by over 50%. Think about that. If they reduce their cost by 50%, they'll be able to reduce the price of the cars and make mass adoption even more prevalent. Now, Tesla has the potential to disrupt the automotive and power generation industries with its technologies for electric vehicles, AVs, batteries, and solar generation systems. Now, I believe Tesla will see higher profit margins as it reduces unit production cost over the next several years. Now, through the combination of industry-leading technology and unique supercharger network, Tesla offers the best function of the electric vehicle on the market right now, which should result in its maintaining its market leader status as the EV adoption increases. So based on all of that information, I am a buy recommendation on Tesla, and I do a 12-month price target of $1,100 a share before the split price target, of course. You know, when you factor in the stock split that's happening tomorrow, that would be a $366 per share price. I'll sum up by saying that Tesla has exceptional growth potential with outstanding track record. That sums it all right there. Now, the risks to the recommendations I have: traditional automakers are investing heavily into the EV development, which will result in Tesla losing market share and seeing deceleration in sales growth to increase competition. I disagree with that risk because I would never buy anything but a Tesla. For instance, I'm looking at the Tesla Cybertruck because I want supercharger networks between here and California that I can just stop. If you look at the infrastructure for any other car companies, to me, it's still a novelty because it's fragmented on where you can charge it. And you have to figure out where. With Teslas, you just type in your destination and it'll drop you right off along the way. And then another risk to this adoption is that the EV adoption is driven largely by governmental incentives, such as regulations and subsidies, which will limit long-term growth for Tesla. I don't see that much of a risk because even without these incentives, Tesla's been doing great. So I believe that will be for other car manufacturers, but I don't think it's going to be that much of a risk for Tesla. And finally, solar power and battery prices will decline faster than Tesla can reduce costs. That's a risk factor. Now, it doesn't mean it was going to, but there's a risk there, resulting in little or no profits for the energy generation and storage business. Well, that's yet to be seen, but of course, that definitely is a risk factor if that were to happen. So there you have it, folks. What are your thoughts? Please leave your comments down below. Do you think it's going to skyrocket to $1,100 a share? I'd definitely like to hear what you think. And as always, folks, don't forget to smash that like button down below. Definitely helps. And consider subscribing and hit that notification bell if you like to hear daily stock reviews and recommendations from an unbiased source. Until the next stock update video later today, folks. Ciao.